76% of Americans live paycheck to paycheck. Is that you? I'm the CEO of 5 different companies. I wasn't born into it. We lived on welfare, but I wanted more. I created this show, The School of Wealth, helping people escape poverty like I did. I want to help you out of that consumer debt, teach you how to increase your credit score, teach you how to make more money at your current job or your current business, and then how to actually create generational wealth without changing your lifestyle. It is going to be a lot of fun. This is not like regular school. Hey, I'm Rondi Lambeth, and this is The School of Wealth. Hello, welcome to the show. Super excited to have a guest on that I've been waiting for quite a while, about a year now. His name is Tyler McBroom, CPA. Tyler, thanks for coming on the show.
Yeah, thanks for having me, Rondi. Glad we were able to work this out.
Yeah, I got a little tongue twisted there, and I don't know why.
A lot of people say Tyler McBroom for some reason, which I'll take it.
I always want to say Tyler McBroom, right?
Okay.
With an L. Yeah. So anyway, I apologize. If I was a professional podcaster, I would have probably hit mute, went back, re-recorded it, but I am not. I am just a wealth strategist that tries to talk about money, credit, taxes, and keep it real. So thanks for being patient with me and let me butcher your name.
Oh, anytime.
So I've been waiting for this interview for a while because ever since I was 15 years old, I left home at 15. I started getting coached by a guy named Wally Williams from John Day, Oregon, where when I left home at 15, that's where I ended up. And I went to work for him at 15 and a half, 16 years old, somewhere in there. And then got licensed as a funeral director, licensed as a embalmer apprentice, and learned all about the human body and how to embalm people and bury people and all that. But I also learned something, and that was it's not how much money you make that matters. It's how much money you keep. And that's something that Wally taught me since I was 16 years old was taxes. And I remember his wife would show up every Friday to get her petty cash. And I always would wash her cars and do all this stuff. And he was always talking about tax deductions. So for me, I'm almost 50 years old. So now really for the last 34 years, roughly 34 years, I've been obsessed by learning about taxes. And it's kind of my sport. And what's crazy about it is I never went into the tax field. I just like it. You know, that's my NFL, if you will. So I've been anxiously waiting to have you on here because I know that you are a tax strategist and you work with my mentor, Tony Robbins, and lots of other people that you and I are friends with. So I was super excited about having you on the show. So thank you for taking this time.
Oh, yeah. Happy to be here.
We are in the middle of tax time, right?
Yep.
Yeah. So I know you got a new book that just come out.
Yes, sir.
What's it called? Let's see it for the YouTube
Grow.
people.
It's basically exactly what you started with, which is, it is not just about what you make, it's about what you keep. And most business owners are way too focused on, how's that top line growing, what's coming in sales, what's revenue, but they're not focused on what they have in the bank. They're not focused on what's actually coming to the bottom line, and they're not monitoring the numbers that actually matter, that drive the future growth and healthy growth of the business. And so I wanted to create a simple book that is easy to read with real life lessons and stories, and just runs through the habits and routines that you need to be implementing in your business from a financial standpoint to grow healthily.
Awesome. I was, about 3 weeks ago, because I just got back from the Bahamas as of today, this recording. And the week before that, I was in Florida. Every 90 days or so, I go to a meeting with a bunch of entrepreneurs. Kevin Harrington's one of the guys that comes in every week or every time. And we talk about business, and people pitch their business and go over their top line. And everybody talks about their top line.
Mm-hmm.
We did 50 million in sales, 30 million in sales. And it's interesting, Tyler, because there's guys in there that are doing 50, 60, 70, 80 million dollars in sales, but netting like $1 million or not netting anything. Look at Uber, for example, or even Netflix. I think Netflix had their very first profitable quarter, like March 2020?
Yeah. Well,
So they have,
Amazon, same thing. That's why everyone loves to harp on Amazon. Oh, they're not paying any tax, not paying any tax. It's because they have a thing called net operating loss carryforwards because they lost millions for years, right?
yeah.
They're doing okay as a business, but
Yeah, they're doing okay now, right? Yeah.
yeah.
So with the book, you really talk about not just the top line, but increasing the bottom line and doing that. And part of that is a strategy on your taxes. Taxes are, in my opinion, I had someone argue with me the other day on this one. I said that taxes are our largest expense in life.
Absolutely.
And regardless of what we do, we can't get away from paying taxes. We can strategize and come up with a tax plan and legally pay less in taxes, but we can't just not pay taxes. That's called tax evasion.
Right.
And
Yes.
you and I both know it's illegal.
That's how Al Capone got thrown in Alcatraz. It wasn't because of selling drugs or killing people. It was tax fraud.
What was it was on the Arte Syndicate Facebook group the other day. Someone had said something about Bitcoin and how it's tax-free money. And I don't know if you saw that post.
No, I missed that one.
It was someone was talking about investing and what do you think about Bitcoin? And somebody put on there, the number one thing to invest in is Bitcoin because it's tax-free. And I responded back with, it's not tax-free. Just because you're not paying taxes on it doesn't mean it's legal.
Yeah, that's absolutely true.
Yeah.
Yeah.
So what else can we get out of this book? I promote a lot of books on my podcast. I'm a huge reader. I read every single day. And I'm not just a reader that reads to brag about I read a book a week or Ty Lopez, I read a book every single day. And then we find out he's not even reading it. It's a staff reading it and then doing cliff notes. But I actually read and implement.
Yeah.
And when I get a copy of the book, because I'm going to go on after the podcast, I'm going to go buy a copy of it on your website or Amazon, wherever you tell me to go. What will I learn in that book, or what will my listeners learn from reading the book? What can they implement from it as well?
Yeah, I think that in addition to the focus on not just what you make, it's what you keep. Two things are, it's key in your business, especially if you're a growing business or just starting out, to monitor your cash and your cash flow. Because once you hit zero in cash, it's very hard to dig out of that hole as a business owner. So I kind of dive into all the processes of having a rolling 12-month cash flow statement. Is most people where you're looking at what's going to be coming in based on what you've invoiced customers or clients, what's going out based on bills that you have coming, and then what's going to be left in the bank. Because most businesses that I've worked with in my time as a CPA, they do what I call manage by bank balance, which means every morning when they pour their coffee, they open up their bank account either on their phone or log in on their computer. And if there's money in there, then they spend it. And if there's not, then they don't, or they put it on the credit card. And you know all about that, I'm sure, with all of your credit history and helping people get out of that mess. But they're not actually looking at where the money's going or where it's coming from. And is that a good number? So it's how to do cash, how to manage your cash, how to benchmark against your competitors. So because someone selling t-shirts is going to have different metrics than someone selling credit repair services, right? Than someone selling financial services, than someone building, running a construction company. So in addition to actually monitoring your cash flow, we want to look at benchmarking against other industry or against other competitors in your industry to say, how am I doing? And is that okay? And then if it is okay, great, keep running and monitoring that. And if it's not okay, how do we fix it? And where that leads to is monitoring KPIs or key performance indicators. And so I dive in the book on kind of high level, how to set KPIs, how to monitor them, which ones are good numbers to monitor, which are bad numbers to monitor. And those are, I'd say, big lessons that business owners that I've seen a major gap in business owners not taking advantage of to build their business in a healthy way.
I remember when I was probably 25, 26 years old. I was a firefighter at the time for Littleton Fire in Colorado. And I worked 8 days a month, relatively 8 to 9 days a month. Relatively was not the right word, but I'm on a roll today. I worked about 8 to 10 days a month, 24-hour shifts, which meant I had another 20 hours. And as someone who strived to be better and provide for my family better, I always had a business on the side. So I started a little construction company called DC Decks, and we become one of the world's largest custom deck builder, number one company in America, number one distributor of Trex products, the Trex decking. And so I was doing millions and millions of dollars in sales. And I remember this guy that I ordered all my post caps and my railings. I'm one of the guys that created that system for decks with the steel pipes, the aluminum pipes, and then we had them powder coated. And now they're really popular. You can go to Home Depot and buy them. Mm-hmm. And so I'd buy, I don't know, $400,000 or $500,000 worth of railing from this guy and have them powder coated in my custom colors. And I remember he asked me one day, he's like, "How's your cash flow look?" And I'm like, "What do you mean?" He goes, "Your cash flow." I'm like, I don't know what you mean. Like, cash flow what? I literally did not know. And I was doing millions of dollars a year in sales. Yes, I was in my early 20s, but I know people in their 50s that don't understand that.
Yeah.
So that's good that you bring it up in the book, because it's super important to understand. And now I log into my bank account. I don't do it every day like I used to. I probably do it now once a week, maybe once every 2 weeks. But I specifically log in on the 25th of the month, every month. And I do the profit first. Man, I'm having a hard time today with my speaking. The profit first method, and I transfer it out to the 5 bank accounts that I have. Gotcha. My profits, my taxes, and all that stuff. So that's really the only day I truly look at it. Again, I've been working on that cash flow thing. I kind of have an idea of how my KPIs works, and I could leave my business for a year, and I did last year. I left for 10 months, and it still continued to grow. We still hit the Inc. 5000 list again for 2020, even though I was kind of checked out with the divorce and everything else. Mm-hmm. So I'm glad you go through that in the book. So what else do you go? Do you go through some of the pitfalls that business owners that you see?
Yeah, and to your point, real quick on that, checking it once a month. Once you get it on a maintenance program where you have the metrics in place and the systems and the routines to do that, once a month is great. And frankly, it's better than most business owners are doing it anyways, because they're not doing it at all, other than looking at their bank balance or when they get the text alert, right?
Yeah, they get your overdrawn alert.
Yeah, exactly. So yeah, those are huge. It's really like, and then we kind of go into some lessons around, like as an example on the industry benchmarking piece. I talk about, so my mom owns a children's clothing store, and this is not someone doing multi-millions in revenue. This is just a small little boutique shop in town, and she was discounting. She came to, we were just kind of having dinner together and with my dad, who's my business partner, and was saying, it feels like I'm discounting a lot of clothes, and I have a bunch of inventory, but I just keep discounting things. And so we said, well, that might just be normal, but let's eat our own dog food and pull up the numbers. Well, it turned out that her profit margins, so her discounts, were about $50,000 lower than they should have been for a retail store her size. And in addition to that, another KPI is days of sales and inventory. So that's a really good KPI if you've got product that you sell. And her inventory was about $50,000 higher than it should have been. So because she was just going, she loves it's kids' clothes. So she'd go, she'd say, "That's so cute. That would look great on my grandkids." And she'd go buy it, and she'd have a ton of inventory, which is awesome for selection, but wasn't good from a actual business practices standpoint. And so just setting a buying plan each quarter when she went to market increased profits by 50 grand, and it increased the amount of cash that wasn't tied up in inventory by $50,000. So on a company that was doing a few hundred grand a year in revenue, $100,000 swing is a big, big deal. So that's one story that has really resonated with a whole bunch of my clients and then people who've read the book as well, who say, that's me. Like I need that. And so that is, one of the biggest lessons. And then I get into a little bit about culture, because in my mind, culture drives profitability too. And we were ranked in the top 20 CPA firms to work for in the whole country for small firms. And so I talk a little bit about the pieces that the kind of the habits and routines that we do to really drive culture and make it a fun place to work, because everyone's leaving our industry right now in public accounting. If you got an industry that's rough to work with, I think it's about as bad of a rap as we get for those crushing, grinding tax season hours. And so we've put some mechanisms in place to not have that. And it's been fun to actually grow a team that people want to show up to work for. So
yeah, that's that. Congratulations on that.
Thank you.
Award or recognition. That's pretty powerful. Top 20, you said?
Yeah, and there's, I think,
top 20,
40,000 CPA firms in the country. Yeah. So
that's a lot. I know with I use a CPA to file my taxes. I don't even know their name. I think it's H&W or something. I've never spoken to them. I never emailed them because I use a tax professional, does everything, an EA, enrolled agent, gotcha. And then he sends it and then they stamp it, right? Mm-hmm. And I've talked about why I do that on my podcast, so I won't talk about it today. But I know on January 2nd, my guy immediately files extensions. Doesn't matter if I'm ready or not. And I'm ready. My books are up to within a couple days.
Gotcha.
Full-time bookkeeper, and she keeps everything up to date. I generally, though, will push it out until September because I just don't want to pay.
Yeah, that's absolutely. If you get a refund, you file early. If you owe, people tend to put it off as long as possible.
Yeah, I just put it off and I file it, and then I have a C corp, so I do the shuffle game.
Okay.
Tax year-end thing with the C corp. So
which you can do with an S corp too, actually.
Oh, okay. Yeah, I have 4 S corps and 1 C corp.
Okay.
And cool. The C corp, I had it set up for a different reason. That was a part of a debt settlement company I had, and so it was very, very high likelihood of litigation. So we made it a C corp. And the rest of them are all LLCs or S corps in Wyoming. But anyway, my point to that was I remember prior to the tax professional I use now, how crazy my CPAs were, like 24 hours straight, 36 hours straight. And I always thought, like, why do you guys like put yourself through this? And why can't you put your clients like on a schedule to where they get it done? So I think you've kind of done that if people like working with you and you got rid of those grinding hours.
Yeah, part of that is really working with we're only working with business owners. And we made a strategic decision when we started really growing a few years ago to say, this is the client that we want to work with. It's got to be a business owner who's actually been in business for a while. They're above a certain threshold so we can actually make an impact on them. And then at that also 10, just kind of non-business owner 1040 clients, with the way the tax code's set up, their returns have one correct answer. So there's nothing we can really do for them to especially in our area of expertise. And we don't even want, it's not worth they shouldn't pay us the fees that we'd have to charge to make the juice worth the squeeze on that. So we just, send them to the guy down the street that I used to work for that it was those exactly what you're talking about. And I remember, going through when it was small shop and we do all of our, from 8 to 5, we're in tax interviews all day long. And then at 5 o'clock, we shut the doors and it was time to actually do some tax work at that point. I'd be doing the prep and he'd go to the fridge and crack open a beer and start reviewing returns. And he'd drink about 4 or 5 beers till 10 o'clock at night, reviewing returns. And I'm like, man, I don't know that I want this to be my future.
Yeah. Isn't that the saying, to choose mentors that have the life that you want.
Yeah.
And if you're working for somebody and you look at the life, your boss, your supervisor, and you're looking at their life and you're like, do you really want to be that person in 10, 20 years? Because that's
Right.
more likely who you're going to be.
Mm-hmm.
What do you think, or not, what do you think? Tell me what the most common mistake that you see people are making when it comes to business, according to taxes.
Gosh, yeah, I was going to say in my real bread and butter area of expertise, I think it's not taking advantage of tax planning. Because as I mentioned, when you're an employee, for the most part, your return has one correct answer as long as you don't make errors, right? From a tax planning standpoint, you can give away more to charity. You're going to get a deduction. You're out of cash, so it's really more about finding a charity to believe in. Don't just give money just to get a tax deduction. Or you get an HSA account and max that out, or you max out your 401k, or put money in an IRA. Those are kind of the things that you can do as an employee. As a business owner, there's a whole new world of tax planning though. Like literally, so the tax code, if we printed out the US tax code and we stacked it up and I held it in front of me, you could grab a Colt 45 Magnum, stand across the room from me and fire it at me, and the bullet would not pierce through the tax code because it's so thick. And a lot of people think, well, that sucks because that's way too complicated. Where I see is problems create opportunities. And all of those are opportunities for business owners to take advantage of the tax code. And most people think that, and the reason why we're so busy this time of year, most people think that the time of year to meet with your CPA or your EA, your tax pro, is February, March. Okay, it's tax time. Let me get my shoebox of death of receipts that I've shoved in the corner all year long and print out my bank statements and hand them over. Usually it's one piece at a time, very slowly. Just give them all at once. And then it's time to fill out my tax return. And that's actually the least effective time to meet with your tax professional. Because number one, we're all stressed out because everyone's wanting to meet with us. And number two, there's nothing we can do to actually have an impact on your numbers. We're just historians filling out the forms at that point. Because once the clock strikes midnight on December 31st and Ryan Seacrest wishes everyone a happy new year, we can't do anything to impact your numbers. And so better is one of the first things that a business owner should do. And when we were at our Arte event back in Coeur d'Alene last year, I remember Mr. Wonderful saying, accounting dollars are the first dollars I spend with all of my investors and all the companies I invest in. And so better is to meet before the end of the year. We run year-to-date numbers and say, if you do nothing, your tax bill is going to be X. Let's do 1, 2, 3, 4 action items so that your tax bill is Y, and it's $10,000, $20,000, $30,000 lower, sometimes a couple $1 million lower. And if we don't meet before the end of the year, then we can't do anything for you. And the faster you're growing, the more often you should be meeting with your tax professional. Because if you're staying steady kind of year over year and your numbers are about the same, then meeting once a year before the end of the year is fine. Hey, did any laws change? Okay, what are the things I should do? Here, give me my marching orders. That's fine. If you're growing, say 20, 30, 40% or more per year, or if you're on the Inc. 5000 list, then your business in January looks completely different than it does in June, looks completely different than it does in October. And there you have access to different types of strategies as you kind of graduate up into different levels of your business. And so having a routine and a schedule to actually proactively tax plan is one of the very first things. And one of the first things that when we get new clients, they go, God, I wish I'd have met you 10 years ago when I started my business. I wouldn't have thrown away, multiple 6 figures in taxes.
Yeah. I meet with my tax professional the second Tuesday of every month. And then we do quarterly as well. And one of the things I tell my clients, the business credit clients and the credit repair and the investing clients, all and the listeners as well, is nobody cares about your money as much as you do.
True.
It's not your CPA's job per se to save you money. Most CPAs, they're just filing their bean counters. They're just filing tax returns. They're not looking to save you money next year. They're looking through the rear view mirror, what happened last year. Now, I know you do things differently. And that's why I have you on the show. And what I tell people is it's your responsibility, you as the business owner, to learn all that you can about taxes, and then get a tax professional that you can say, hey, I learned this. How can I do that? Because most CPAs are going to say, get an IRA, get an HSA, set up a SEP, do charity, right?
Right.
And I know you do things a little bit different, and I appreciate that. So what about incorporating? This is something that I see a lot, that because I deal with a lot of mortgage bankers and real estate agents and real estate investors. They're sole proprietors. In fact, I met with one. He called me on December 30th, Tyler. December 30th, I was in Costa Rica on my annual officers meeting in Costa Rica, because I always go out of the country and I take all the officers, my board members. And so we were in Costa Rica on the beach, and he called me, and December 30th, and he's like, hey, I made this much money. What can I do to save on taxes? I'm like, it's too late.
Yeah.
But when I get back from Costa Rica, we can sit down and we can talk. And so I sit down, and the number one thing, he was sole proprietor.
Yeah.
Yeah. Sole proprietor. I'm like, well, this is the first thing we got to do. And he's like, well, my CPA said I shouldn't incorporate because it's expensive. So what do you say about that?
Yeah. Actually, so before we really started growing through, before my Instagram and social media presence really took off, and then we got aligned with Tony Robbins, we had about 40 to 50% of our clients were realtors. And the reason why is because we did exactly it was someone exactly like what sounds like the guy called you up on December 30th. They need help. They don't know what they're doing. And they're throwing away so much money by not filing as an S corporation or as a sole proprietorship. So to touch on that, and kind of the reason why it makes sense is, yes, it can be expensive in that you're spending a couple extra grand a year with an extra tax return, and you have to do your annual minutes, and you actually have to keep bookkeeping records, which you should be doing anyways. That's one of the best things you can do to lower your tax bill. We can get into that a little bit. So you should be doing that anyways. But the cost it's going to save you 15 to 20 grand a year potentially. And the other side benefit is the audit rates are about 6 times lower than as a sole proprietorship. So as a sole proprietor, you've got about a little under 2.5% chance of being audited. And as an S corp, you have a 0.4% chance of being audited. So that's a perk too. The tax savings is primarily in the form of self-employment tax, which is essentially your portion of Social Security and Medicare as a self-employed individual. So when you're a W-2 working for the man, earning your paycheck, let's say you're making $5,000 a month and you get your pay stub. Well, you're not taking home $5,000 a month, right? So you look at your pay stub, there's an amount taken out for income taxes and then Social Security and Medicare. And that Social Security and Medicare is about 7.5% of your paycheck. And then your employer matches that, sends 15% into the IRS. When you're self-employed, and this hammers so many people when they're self-employed and first start making some real money in their business, there's no one to withhold that 7.5%. There's also no one to match it. But the IRS, of course, still wants their 15%. So you're left holding the bag for 15% self-employment tax and the first $133,000 of your income on top of income tax. So that's an extra 25 to 28 grand a year potentially. And that's all well and good because it means that you're earning Social Security credits, whoop-de-doo, if it's even around by the time a lot of us retire. But the way that Social Security works and why this is really, really a critical tax saving strategy is on the first $15,000 of your wage or of your self-employment tax, 85% of the tax you pay goes into your actual Social Security bucket. So you're getting credit for it. It's adding up credits. All right. So you can access that in retirement. Between 15 and 45,000, that number drops to only 35% is going to your actual bucket. The other 65% is going into the Washington Fund Money Fund, going to help people who are earning less and fund their Social Security. And then on everything above 45,000 until it caps out at 133, so the vast majority of it, only 15% of the tax you pay is going into your Social Security bucket. So you can form an S corporation, pay yourself a reasonable salary of, let's say, $50,000. And if you make 150 grand of business profits, and previously we're paying $27,000 in self-employment tax, and now you pay yourself a $50,000 wage and take a $100,000 profit distribution. Now, instead of $27,000 in self-employment tax, you're paying about $7,000 or $8,000 in payroll taxes. Now, I don't know who you're going to, but most accountants I know aren't charging 20 grand a year to file an S corporation tax return. Certainly not for a real estate agent, tax return. So yes, it costs you a little more, but the savings, in addition to the sleeping better at night because your audit risks are lower, allow you to, more than pays for the cost. And then it also has other tax advantage things you can do, like renting your home out for a shareholder board meeting, which we can talk about as well. But if you're making about 60 grand a year or higher, then, and depending on your state, there's a couple states it doesn't work for, but it's the first easiest thing you can do to significantly drop your total tax bill.
Yeah, and that's something that I recommend to all my coaching clients. And I'll just throw this out there. I am not a tax professional. I'm not giving you any advice on anything. And you should, and I always say this, always talk to your tax professional, talk to somebody like Tyler, who is a CPA. I'm just sharing with you my opinions on what I've heard and what I've learned and what I paid tens of thousands of dollars. My tax strategy guy, it's about $75,000 a year is what I pay my guy. Mm-hmm. But I haven't personally paid income tax in over 10 years. Mm-hmm. And so it's well worth it for me.
Yeah,
but your average, it's a great ROI, right? And we do some crazy stuff like captive policies and defined benefit plans and some other stuff that I won't really get into. But there's ways that you can legally reduce your taxes to almost nothing. And then with the apartment complexes, it pretty much wipes out all the depreciation on the apartments, wipe out all my personal. Yeah, cost seg. So, but that's usually the number one thing I recommend is when people are making $50,000 to $100,000, and most realtors that are doing this full time are making 100 grand a year. Yeah. And that's the first thing I say is you need to incorporate, whether it's an LLC, taxes, an S corp, or whatever. You talk to your professional. Yeah. Let's wipe out that self-employment tax because it's 15% off the top. Uh-huh. So. And just to reiterate what you said, it's 15% that above your salary. So you have to have a reasonable salary. And this is where people get messed up, as you will attest to, is what's reasonable. Mm-hmm. And I think you'll probably agree with me. It's you go on Google and you type in whatever your job is in your state, because if you're in Arizona versus Manhattan, right, Scottsdale versus Phoenix or Austin versus Boise or whatever,
Omaha,
there's a
Nebraska.
Huge difference. Yeah. Right. And so there's a big difference on what an office manager, if that's, you might be the owner and CEO, but you're really being the office manager. Mm-hmm. Then you go to Google and you type in office manager in Omaha, Nebraska. Yeah. And then you figure out if you're working that. And correct me if I'm wrong on this. What I've told people is if you're the owner of it and you're acting as an office manager, are you working 40 hours a week as the office manager? Or are you doing other things, working on the business?
Correct. Yeah. That's actually a great piece that I was going to talk about is we want to look at, you want to have a reasonable salary, but we want it to be the lowest justifiable, reasonable salary that we can have. And so, yeah, you might be working. So let's say you own a marketing agency, you might be doing some of the marketing work. But if that's 20 hours of it, and the other 20 hours is kind of managing the risk of the business, then that's what you're getting the K1 profits for. And the other half, so if a marketer in this example is a $60,000 a year wage, and you're spending half your time doing that, well, that can potentially be a $30,000 justified officer salary. Yeah. And so that's how you can play with that.
Perfect. Because like with my company, Fortress, I honestly work about 4 hours a week as
Okay.
the CEO, working in the business, doing stuff. Most of my time is doing podcasts and interviews and TV and traveling, and prior to COVID, doing speaking engagements.
Mhm.
That was the majority of my time. And so my salary, surprisingly, is lower than most of my employees.
Gotcha.
My salary. Now,
Yeah.
dividends are different, but I don't have to pay self-employment tax on
Correct.
all the rest of it. So I say 15% off the top.
Yeah.
What else can we write off? I want you to talk
Yeah.
about putting your kids on payroll, because I tell people this and they always ask the same question. Well, how old do they got to be?
Uh-huh. Yeah. Yeah. So I'll explain
Let's
the
talk
rule.
about
And
that.
I'll answer
Yeah.
that question. So the IRS has a rule that says if you pay your under 18 children from a sole proprietorship or an LLC that is owned by you or just the two parents, then there's no payroll taxes on the wages you pay that under 18 child. And under the new tax law, it used to be smaller, but now the standard deduction increased significantly. So a child can earn a little over $12,000 a year and pay zero federal income tax. Now, depending on the state, they'll pay a little bit of state tax. They pay zero federal income tax. So you hire them, get them on the payroll. And number one, you actually have to pay them. And number two, they actually have to do something to justify that wage. And you get a $12,000 a year tax-free money for doing that. Now, the actually have to pay them part, how that works is this. We just talked about getting in an S corporation. And then I said the benefits are if you pay from a sole proprietorship.
Yeah.
What do you mean? Well, where the mistake, because paying your kids is not that unique and new of a tax saving strategy. Where the separator is most people have most CPAs have their clients pay their kids directly from the S corporation. And if you do that, then it's subject to payroll taxes, which is 15% on the wage. So it costs about $1,800 a year per kid. So what we do is we get a tax ID number that's a sole proprietorship, that's a labor management company or a marketing agency or just a talent management company. And you transfer the money from your S corporation as outside services to your personal bank account. That's a sole proprietorship, and you 1099 yourself. And then you put the money into the kid's account. And that's a W-2 issued from your name to the child. So that's how that works logistically to get out of the payroll taxes. What do they do for the wage? And, if they're older, if you're a real estate agent, you mentioned, you can take them door knocking with you. You can have them help with some of the paperwork. For our younger children, what a lot of our clients do is hire their kids as models for their social media pages and websites. People love doing business with a family man or a family woman. My kids are all over my social media, and a lot of people who are doing anything online have pictures of their kids up there. And we actually did some market research. We have a client who has children who are models. So we gave them a call and said, hey, just out of curiosity, what do they make per shoot? And they made $500 a shoot. So if you set them up on a monthly retainer for a couple shoots a month and take some pictures, post them up, that's your $1,000 a month wage. And that's how you have little Johnny, who's 18 months old, justify a $1,000 a month salary. Now, the cuter your kids are, the more you can justify charging. But in most parents' eyes, their kids are pretty dang cute. So,
Back up a little bit, because I want to dive into that.
Yeah.
Because it's something that when I owned my construction company, I have 3 kids, and I paid them 25 cents per screw that they picked up off of the client's grass and yard.
Okay.
And these screws, they were very special screws, and they would cost me anywhere from 50 cents to $1. And when you're 30 feet up in the air, sometimes they fall.
Yeah.
And so they're expensive. And I didn't want to leave a bunch of screws and nails in my clients' yards. And so my kids would literally get on their hands and knees and crawl through in the summertime, crawl through the grass and play and pick up screws. And I paid them. So their entire childhood, they got paid from me. I never gave them allowance. I didn't buy their cheerleading outfits or pay for their soccer schools because they had their own money. So I've been doing this forever. I do it with my grandson. Some of my best videos on YouTube, best viewed, are my grandson explaining how he hates income taxes.
Gotcha.
because
Nice.
I give him an allowance to pick up dog poop.
Okay.
And then I make him pay taxes, and then I make him file a tax return. And he's been doing this since he's 6 years old. Now he's 10. And then he does his tax return, and then he gets the money back at the end of the year. And I play this game. And so I got some videos where he talks about how he hates the IRS and he doesn't like paying taxes and how he writes things off. And but I want you to dive down. So you're an S corp. You set up a sole proprietorship.
Yeah.
You get an EIN number from irs.gov. You file it. Is it for banking purposes only? For the EIN?
It's actually so that you can file the payroll tax forms and issue them W-2.
Okay.
You don't even have to have a separate bank account. When you're a sole proprietorship, your business is you in the eyes of the IRS. So I always recommend, if you're running an actual business, to have a separate business bank account. But it can just be cut straight to you in your personal account. So it's not for banking purposes. It's for payroll tax purposes, so that you can file your 941s, your W-2s, all your payroll tax forms.
So you set up a sole proprietorship. Do you need to have the child on the bank account as a signer with you?
That should be. Usually it's a savings account at most banks. They don't let a kid open a checking account, but it's just an account in their name.
Okay.
And then from there, if they want to gift that money back to dad or back to mom, that's $12,000 is under the annual gift allowance. So
so this is just a way, you got 3 kids. If you're listening, you got 3 kids. And I've always said above age 6.
Yeah.
Would you say about age 6?
It's one of those.
Other than the modeling.
It's kind of a pigs get fat, hogs get slaughtered.
Exactly.
And then we have the grin test. So, if you're getting audited and you're the auditor sitting across from me and you ask me what this expense is, got to be able to tell you what that is without grinning for at least 60 seconds. And
when I had my office prior to COVID, my grandson come into the office every day, emptied the trash can for 22 employees, vacuumed, wiped down all the keyboards with Lysol wipes.
Yeah.
Made sure he emptied the trash cans in the bathrooms, into the kitchen, did the dishes, made sure there's toilet paper and paper towels. So I paid him as a janitorial expenses.
Totally.
But you could do door knocking. If you door knock as a real estate agent, you have your kid follow along with you and put flyers on.
Your close rate goes up.
Yes, for sure. So we got that. So that's how you do that part of it. And it's about 12 grand, a little less than 13,000.
It's 12. I think this year is 12.6. They started adjusting it by $200 a year with, it used to be 12. Now it's like 12.2 or 12.4. I don't memorize those numbers, but
so
then once they're over 18,
once they're over 18,
once they're over 18, still dependent. So you can jump that up to about $30,000 to $35,000 tax free. Like if they're in college, and by opening up a marketing S corporation in their name and hiring that S corporation that they own passively. And it's more complicated than we have time for, because I know we're running out of time. But once they hit 18 and you're supporting them, especially if they're going to college, and this works if you're supporting your parents too, you can get about 35 grand a year tax free.
I did this for my grandmother.
Okay.
She was in a nursing home. They had to liquidate all their assets. My grandfather died, and all their money was from his military pension. And once he died, the pension's gone.
Yeah.
And so we put her in a nursing home, and she still was able to drive and all that. She just wanted to hang out with her friends and not be alone. But she didn't have any money. So I actually did the same thing. I put her on as marketing, and she did some stuff for me.
Gotcha.
It was extra money that I was already giving her. That was the thing.
Exactly.
I'm already giving my family money.
Right.
Now I'm running it through the business to write it off.
Shifting it from your higher bracket to to almost a nothing bracket.
And that's why I tell people, even if you have to pay them more than $12,000, they got to pay taxes, they're going to be a lower bracket than you.
Yeah, exactly.
So, because I'm at 37, soon to be 39, if Biden's thing goes through. And so for me, before my deductions, rather, I'm at 39. But I want to talk about this because we're almost out of time. I could talk for hours and hours on this. This is something that I've in private talked to a lot of people about, because I'm kind of in that circle with exotic cars. I'm into cars. Our good friend Andy Frisella and Ed Milet, they're into cars. Andy especially is into cars.
Oh yeah.
And I write off my exotics, but I do it in a way, it's a marketing expense. some people have come to me and say, hey, I just leased a Huracan, a Lamborghini Huracan, or I leased a Bentley, and I'm writing the whole thing off. And I say, well, you might think you're writing it off, but there is a limit to how much you can write off on luxury vehicles. So let's talk about that.
Yeah. So the luxury vehicle limits, basically there's a cap per year on depreciation that you get. It's around $10,000 or $11,000, where normally, it's the price of the car divided by 5 over a 5-year period to get depreciation. And then once you hit the 5 years is up, then they tack on at the end an extra $5,000 or $6,000 that you get to depreciate as long as you own the car. Basically, it just drags it out longer. And the reality is, anyone who's buying those kind of cars isn't going to be holding on to it for, at least as a driver. They might have it sit in the garage. If it's over 6,000, it doesn't matter how fancy the car is, you can write it off in the first year. So if you're looking at,
it's over 6,000 pounds.
6,000 pounds. Sorry,
for Section 179.
Yeah. So there's no limits as far as, like, if you buy a Lambo SUV that's big and it's $400,000 car, there's no limits. If you buy a Lambo car, then they have those limits in there. And so
isn't the leasing at $18,000 a year is the most you can write off for the lease?
Yeah, it's around there. I don't memorize those numbers. It's right around there. And then if you write in more, then it ends up having to get included in your officer compensation and overall tax.
And that's what I specifically, I had a guy recently reach out. He just leased his 3rd Ferrari. Gotcha. And he's like, yeah, I'm writing off $12,000 a month. And I'm like, no, you're not. You're writing it off, but it's adding it to your officer compensation later.
Right.
He goes, well, my CPA never told me that. I'm like, well, you are.
Yeah.
It's because I believe it's $18,000 a year per luxury. It was Obama put it in place a while ago. It's like $1,500 a month. Now,
airplanes are subject to Section 179 now. So, and bonus depreciation. So if you have a plane, there's limits. It's either $1 million or $2 million a year that you can deduct. So you can't go buy a $10 million plane and write it all off in 1 year. But that does count same as a large vehicle.
I'm going to do that. I have an airplane now. I'm looking at a Citation 7. So that's like a 2023 goal for me, is a Citation 7. I got to work up my speaking engagements to justify a Citation 7. But I did not know I could Section 179 them. So that's pretty cool.
Yeah.
That you can do that. And essentially go ahead and explain real quick what I've talked about this dozens and dozens of times.
Yeah. So essentially it allows you to, as long as the vehicle or the business asset you purchase is over 50% business use, you can write off 100% of the business portion of it in the year of purchase. So normally a $60,000, say a $60,000 Tahoe, you'd write it off $12,000 a year over 5 years. Instead, if it's over 50%, then you write off $60,000 in the first year when you buy it. Yeah. So that's what that is.
So for example, in December 2019, I bought a GMC Denali. It was $84,000. I put $1,000 down with my American Express card. And the next day I got a $84,000 write-off, even though it's zero money out of my pocket.
Yeah.
The disadvantages of that is if you go to sell it in 2 to 3 years.
Then you pay tax on the entire sales price
of what you sell it for.
Right. So, not what you bought it for.
Yeah. And so it basically, when you trade it in, the idea behind this is you buy the truck, you keep it for 3 years, or anything over 6,000 pounds. Could be a Mercedes G-Wagon, could be the Bentley SUV. They're all over 6,000. They purposely put them at 6,000. You write it off, and then when you sell it in a couple of years, you pay tax on the amount of the trade-in or the value, and it just comes off essentially you don't get as much write-off on the new vehicle.
Right.
Or just keep it on your balance sheet until it just depreciates to nothing.
Yeah.
Yeah. But it's all fun. I mean, I love the tax code. I think it's 42,000 pages. You started a podcast talking about that. I think it's around 42,000 pages, something like that.
Yeah, it's big.
And what I love about it, Tyler, is it is an equal playing field for everybody. And, people will say, well, it must be nice to be wealthy where you don't have to pay taxes. anybody can do this.
Mm-hmm.
Yes, there's certain strategies that only if you make X amount of dollars, like the captive policies,
Right.
you know, but anybody can have a business and get it successful enough to have a captive policy.
Well,
A
and
defined benefit.
And I will say, someone who's making $100,000 a year and they meet with the tax pro and like we save them $25,000, that makes a way bigger, significant impact on their lifestyle and actual like what they can afford to live on, compared to someone who's making $1 million a year and we save them $250,000, right?
Correct.
So
Yeah.
it matters more when you're in that kind of up and coming phase of your business.
It does. Tyler, I would love to have you on here for several more hours. I know you're extremely busy, especially this time of year. Where can we find you? I know you have a large following on Instagram.
Yeah.
So what's your handle there?
Yeah. So it's just my name. So Tyler McBroom, and you can go over there, shoot me a DM if you got any additional questions or want to chat. And then I've got my book. I'm building out my actual book page, but it's available on Amazon right now. So if you just search my name or Cashflow and Grow, you can get the book either on Kindle or on paperback. And I dive into a lot of the stuff that we cover here. So
Cash, Flow, and Grow by Tyler McBroom. Yes. So I'm going to have it on the show notes. There'll be a link to that Instagram cart. So you can just go to the show notes. If you're watching this on YouTube, scroll down a little bit and you'll see the links there as well. Thank you, Tyler, so much for coming on the show today. I appreciate it. And I will see you at our next Arte event when we have one.
Sounds good. Thank you, sir.